Hey, everybody. Listen, if you're like me, every once in a while you're turning on the news or you're listening to hear what is going on in the world of economics and markets and trade and you name it. Jean Goldman joining me here today, Chief Investment Officer, Director of Research, Cetera Investment Management. And you know what the deal is for today? The deal for today is to take a look at where we are, where we're going, and what sense does this make from one of the leading experts in strategic direction and growth. And that's what this is about. Thanks, Gene, for joining me here today.
Thanks, Dr. Pat, and my pleasure. Hope you're doing well.
Doing awesome. Look, if you're like me, you've gone to school, you probably got some kind of education, maybe a bachelor's, maybe not, but you had to take the dreaded economics class. And you walk out of there and you're still scratching your head. And so that's why you're on the show today. Many people don't quite understand. Tell us the good news and the not so good news. Where are we with the markets? Where we're going?
Totally agree. Some of the stuff we learn in economics is just all mumbo jumbo. So you get that. So the good news is we just finished our mid-year outlook, and what we're calling it mixed signals. And mixed signals it's true. The economy right now, looks great. We're seeing a 50-year low in unemployment. We have 1.6 million more jobs available than people looking for jobs, and this has been for 14 straight months more jobs than people looking for jobs. People are spending money, wages are coming up slowly, but at the same time, though, you're seeing some weaker data. Manufacturing data is slowing down, services data. So while data is cooling, we're still expanding, but data is cooling. Second of all, the stock market valuation, it's pretty high. It's up there. It's up there, and earnings growth is expected to weaken in the second quarter and the third quarter, so that could put pressure. And the other mixed signal that we're seeing is the treasury yields. Okay, so everyone talks about the inverted yield curve. What this means is that short-term rates, like a 1 month and a 2 month, are trading higher than long-term rates, and that usually suggests that the market is concerned about some bad news coming down the road. But at the same time, and this is the mixed signal, in the bond market also, you look at risky debt, like high-yield bonds. They're trading a very tight spread to treasuries, suggesting there's great news coming. So it's lots of mixed signals right there in the market today.
Yeah, it is. And I think one of the things to talk about, and this is an area that I love to look at, with my background is, the psychology of money. And what I mean by that is that it's going to be difficult for the generation that went through 2007, 8, 9, 10, 11, whatever you want to call that period of depression, right? Economic downturn, people losing their homes. It's going to take a bit, almost like an over-aggressive result to give people confidence and trust, isn't it? Because that's really what we need to build here. We have to build some kind of trust in what we're doing financially.
I totally agree with you. I think the Great Recession, from 2008 to say 2009 or 10, that was a tough time for us because a lot of new investors came to the market. Immediately, they saw a sharp decline in values. But the good news, and I'm going to give a personal example. My mom, as part of the real estate crisis in 92, 93, she lost her home. And, now that she's back in investing in real estate again, because at the end of the day, things happen, but long-term investing, long-term focusing, the home is important. So I wouldn't let a 2008 recession kind of change your listener's psyche, but instead, keep in mind, the long-term average of the stock market is 9.3% since 1933. So we will have some ups and downs, but the good news is that we continue to be a more stable foundation. For example, going into the Great Recession, we saw a huge oversupply of homes, causing a lot of pressure on home prices. Today, yes, we have some pockets of strength in the East Coast and the West Coast, but at the end of the day, we're not like we were back in 2007, 2008.
No, we're not even close. We're not even close where I live in the Pacific Northwest. I mean, the bottom line for us is the demand is so great and the supply is very low. So we're actually in almost an inverse relationship. I want to ask you a question. You really are on the pulse of this. You're on the pulse of it. what, in your opinion, is the effect of trade tariffs, the perception of this? This is a new word for us right here. I mean, it's not new policy, but everybody pretty much, unless you're like not paying attention, is hearing the word tariff. And many of us don't actually even understand perhaps what that means.
No, and there's a famous economist, Adam Smith, who warned about trade wars long time ago. And he's probably rolling in his grave today saying, what is going on with these trade wars? And unfortunately, the trade war, let's talk about you and I and your listeners. So the trade war, unfortunately, prices have risen. You look at, a tariff that gets added to a good coming into the United States from China. So you add a tariff, you increase that cost, so you and I pay more. The problem is that some, I'm not saying all, but some American companies that were competing with these companies, these ones with higher expensive goods, they've also raised their prices to match those tariffs. So instead of keeping the prices where they were in order to increase market share, what they've done is actually matched prices on these more expensive tariff goods. So unfortunately, you and I pay for those goods, and your listeners pay for those goods too, the increased price. So that's difficult right now. But the good news is that despite all that, employment is still very low. Jobs are plentiful. Wages are picking up. So that's good news there, given the increase in prices.
Yeah, I got to tell you, I live in the state of Washington where, our governor, who's actually running for president, made no bones about boosting the minimum wage. I mean, those of us that are in small businesses, we got ahead of the curve and we jumped to a higher minimum wage right out of the gate. We didn't wait for the 3-year period. And so for many people that are listening, the question really is, and you're on the pulse of this again, is where's the room? And what I mean by that is usually people look at room. They don't want to have the sense of it's too late for me to get in the game. So I want to ask you if you could just recap that. And then how can people get more information? Sometimes people look at something, right, Gene, and they say, oh man, I'm way late. I'm way late to the party. I don't think I'm going to go, right? But we need to have an understanding. Are we way late to the party, or is there room?
No, and the answer is no. I mean, yes, we are in the longest bull market ever, so we've had a great time in the stock market the last 10 years. Yes, risks have increased, but at the same time, though, the stock market is a great investment opportunity. As I mentioned, average investment return is 9.3% per year since 1933. Yes, sometimes it can be volatile. Yes, sometimes stocks can go down, but long term, it's an upward trend. Case in point, and I don't have the exact sets, but something like the stock market has been up, I think something like 20 of the last 30 years, and the average intra-year loss is negative 14%, even in those positive years. So while stocks have been positive, you do see fluctuations. So what I would always stress is what's called dollar cost averaging, is that do we know the stocks are going to go up today, tomorrow, the next day? Don't know, but put a little money in every single day or every single week or every single month, a little bit, what you can do to save. And, you help to smooth out that volatility, and you help to, if prices go down, you get to buy more shares. Prices go up, your value goes up. Dollar cost averaging is definitely a great investment opportunity.
Yeah. I want to take a minute and I want to ask you, people probably are picking up a large part of what we're saying, but if you're anything like me, you like to dig in a little bit more for more detail. What is the best way for people to find out more about you, what you're doing, what the company's doing?
Sure. The best thing is, I feel like a millennial now, but Twitter is probably our best way to get information. So we have a Twitter. I'm learning terminology. So our Twitter handle is Cetera, Cetera IM, like investment management. So Cetera IM, and we post tweets, a couple times a day. We just posted a tweet this morning talking about the price of gold. Do you realize that gold is that, given the concerns about Iran and the U.S., global uncertainty, gold is back. It's at the highest level since May of 2013.
Yeah.
We just posted it today. So
yeah. Yeah, I totally know. I mean, it's fascinating because those of us that are a few years older, we only bought gold for jewelry and other things like that. We can come from that generation. And then, of course, other precious metals got introduced. I want to ask you this question of how, or your opinion, because look, you are a leading expert here, right? You hold Series 7, 63 security registrations. I could go on about that. Are there any concerns that you could think of right at the moment? Or maybe concerns, not the best word, Gene, but it's kind of like what folks should be made aware of. That's a better term.
About the overall economy or the markets?
Yeah.
Concerns. Yeah, there's, you can't, we obviously don't live in a vacuum. So there's some positives we can talk about, like, and again, unemployment is so low. There's some concerns that we have. So obviously the trade war, we want to get it resolved sooner rather than later, given the tariffs and the impact on the economy and the stock market. Europe is very concerning too. Europe, you think data is slowing down here. Europe is pretty tough. And we'll give you some examples. German business confidence fell to its lowest level today since November of 2014.
Yeah.
You look at German auto manufacturing has declined dramatically. German, in the United States, our GDP in the first quarter was around 3%. In Europe, it was 1.6%. We talk about inflation; they have almost no inflation out there. And let me give you one example. This is, Dr. Pat, this is something interesting. In the United States, the 10-year Treasury yields about 2%. So that means if I borrowed money from you, you charge me 2%. You charge me 2%. Okay.
Yeah.
In Germany, though, the same 10-year German Treasury has a negative 0.3 interest rate. So that means if I want to borrow money from you from 10 years in Germany, you're going to have to pay me money to borrow from you because you're so concerned about the future economy. This is what worries us. This is what keeps us up at night.
Yeah. And, you're absolutely right. I mean, I one of my top programmers who designed our technology for the network is in Germany. And it's hard when you're so far removed to really get a sense of where, what the pulse is of what's going on with folks. Today it's a good day if we think about this. It's a good day if we're looking at where we are with markets, where we are with investments, where we are with optimism. What's the most, I know you got to run. Last question, and please give out the website again. What are you most optimistic about?
Sure. 3 things. Number 1, the trade war will be resolved very soon. We really believe that. There's multiple reasons why, given the effect on the stock markets, given the effect on the economy, plus the demographics in China are getting so bad, they're under pressure to resolve the trade war. Number 2, the Fed. The Fed is on our side. The global central banks are on our side. The Fed will likely cut rates sometime this year.
Yep.
That makes our interest rate costs lower. And the third point, economic data is not that bad. It's still expansionary. While coming down, it's still expansionary.
Awesome. One last thing, website. Thank you, Gene. And last thing, personal message. What do you want to leave us with?
Listen, markets are a volatile time period, and markets move up and down. We've had a nice period of low volatility. Market volatility will pick up. Definitely stick to your long-term investment plans. Dollar cost average, and if you've done really well in the stock market, it's okay to take some profits out and go back to rebalance back to your original portfolio. It's okay.
I love that advice. Thank you so much, Gene. Thank you for all that you're doing. Very important information for all of us. Thank you. Let's take a short break, everybody. We'll be right back.